got that G, got my nullos. I'm just saying. We pull up to the scene, they be filled with jealousy. If a bitch get
stop
finicky, she gon' bring the energy. I hit a phone with a
3, 2, 1, action.
Dear light.
So hello everyone, Savidi and I'm back for another video and I hope you guys are having a good time. Welcome to my channel. How are you guys doing? What's going on? Let me know in the comments below, okay? But we are here for another form of option trading, honey, and this time we are discussing how to buy a call. Yep. Oh,
I could be like everyone, but I'm not like anyone. This ain't no allegedly. Feeling like a psycho freak sometimes.
so with this you would have your buying power ready, just so you know. So how to buy a secured call. So I am taking you to my portfolio, which I already opened, so to make it fast. So I'm going to AVPT. Now let's say I want AVPT, I want it to be out the money. Right now it's at 5.12 and this company, I love this company, I want this company so much. So I'll go to AVPT and see if they have that, but I want it at a reasonable price that I can afford, okay? So I would say option, I would say single option, one way or the other, okay? I'm going to call single option. Okay, now I would pick, let's say $5 or $6, but I will be picking $5 for this demo, okay? Because I want the market price by the time I will get the stock to be higher when I'm getting the stock at a lower price. You see that? Because when it's higher, then it makes sense to buy it at a cheaper price. But when it's lower and then the stock price, if the stock price is lower and then my call price that I bought is higher, it doesn't make sense. It will be worthless, because why do I want to buy something expensive when the current market price is low, okay? So that's when you use this option, when you want a higher stock price at a lower price. That's when this option would be accurate for you as a beginner, okay?
Treat me like a dream.
Look at the map, the graph shows you. So we are picking a strike price of $5. Right now this company is worth $13 when I got it, but the company right now is at $5 plus, or let's say it's at $7 currently. Let's put it that way, okay? So I would say long call, buy and call. Now if this stock goes beyond $5, I'll be making a profit because I am now getting this reasonable price at $5, right? So anything extra is now a profit for me, right? So then this would be wise to use when buying a call. But if the stock is at $4 and then I'm going for a call of $6 or $7, it makes no sense, because if this call expires, this option trade expires, then me buying the stock at $7 will make no sense. So my deposit that I have paid for this call will be worthless because the strike price was not met, okay? Or it wasn't above the strike price. So you want it at the strike price or above it, okay? You don't want it below the strike price, okay? Debit, you see, you have to have a buying power for this. You will be getting no premium because you're the one doing the paying. You're the one doing the buying of the call. When you click on this, so the people who are willing to sell are selling at a higher price because they know that if this stock appreciates, they would lose. So they want a premium, right? You are bidding, people are bidding at 20 cents because they want it, you know, they want to pay a reasonable amount, but having the intention that if the price bounces up, they would make profit from it. So this is why we have that bid and ask. Okay, now I would show you this. So when you click on that, see that it says you are buying the right to buy 100 shares of AVPT at $5. So whenever you're bidding for this, you're going with a lower strike price, so that way if this stock goes above it, or you believe that this stock will go above it, then you can go for this option. You don't go for this option if you feel the stock will go down. So when you go for this option, you are bullish. You are bullish on the stock. Okay, you are not bearish, you are bullish. Bullish on the stock. Okay, if it's for the put, then you're like, okay, you're bearish on it. But in this situation, you are bullish for the stock. That's when you go for this type of option or strategy. So if AVPT shares are lower than $5 by March 18, 2022, this option will expire worthless. And when that happens, you who paid $45 as a premium to the seller would lose that premium, because hello, you can always go, you know, into the open market and get the stock at a cheaper price. So you're only going for this option when you feel that the stock would appreciate beyond your strike price in your call option. Does that make any sense?
Treat me like a treat me.
So a stock is $7 today. You are buying a call for a $5, for example, because the person who would sell would want to sell this stock price at $8. So they wanted, the person selling wants this in the money. You buying this call option, you want it out the money, because that way you'll be getting a great stock at a lower price with the potential of growth beyond. Okay, that's why you have this. See, so anything below $5 you would lose as the buyer, but anything above $5 you would make money, because the rest of the growth of this company goes to you, because now you have bought the stock at your strike price. So the rest of the growth, the potential is unlimited. But if this stock, after it has expired, the option, the stock decides to go down, at that point this person has already taken that premium. They've gone their way, they've sold the stock to you, they've gotten what they want, and they are on their way out. You see, so that's why this is not good. See,
Maybe I'm an alien, Earth is hard.
you see that when you click on sell, short sell, you see that? So the person that sold the call to you would be losing money during the period of time. Okay, so you would want this stock to appreciate in value, so that way you can buy the stock from them and take it away. But now the rest of the way, they would not be making any money. They'll be losing money, because the rest of the growth, they are not part of it any longer after this has expired. Okay, but when it's still, you know, in the contract, they are the one bleeding, because now this stock is at, let's say, $7, right? You had a strike price with this person at $5, so they would have gotten an additional $2 gain, but they are now losing that $2 gain because they cannot sell this stock. It now belongs to you. You are now the one making that additional $2 profit. You see that? That's why buying a call option can work if you know what you're doing. For a beginner, this is another option you should consider. If you believe in a stock, you've done your research and you believe in it, then you can buy a call of a stock that maybe currently is at $7, and the person who has the stock is scared that it may drop, so they're like, okay, let me do it. If this drops to $5, I'll just sell off and move on. Okay,
Look at us. Look at us. Huh? Who would have thought? Not me.
Now, if that happens, you, the buyer, can now buy at this price. You would have a debit to your account. They would have a credit to their account while waiting. Then if this strike price is met, the stock now belongs to you, because now you have to buy the stock from them on the day of expiration or before the day of expiration, provided that strike price is met. And they would now have to give up the stock. So any future gains after that belongs to you, but they would never participate in any future gains. So they, if really they don't want to lose this stock, they would want this stock to be in the money of the strike price, because this is the $5, right? Strike price. They would want it underneath, so that way they make money and keep the collateral. You would want it out the money, out the 5, so that way you're getting the stocks at a reasonable price that you wanted. Okay, so that is why this option is unique. So that is how you sell a call. Okay, and when you do that, you click on your buy and then you click confirm. Remember, today you cannot do any because it's the weekend, but during the weekdays, that's when you do this. Okay, or you can always go to good till cancel and then it will go through. I don't have any. Do I have any buying power? Oh, I do have a buying power. Okay, but the buying power I have is only $14. Okay, let's see. Okay, let's try this. I still need. Okay, so when I say buy, let's see, not supported, so I would go with good till cancel, and there, see, so now it's working. So this is now a strike price. So if this stock comes down to $5, I would sell off thinking, okay, I'm holding you know, taking my little profit and I don't care about this stock, I'm moving on. But you, the buyer, you're like, okay, this stock is now mine at this price. And then if it bounces back to $7, $8, $9 now, you who bought this call, you'll be making the rest of the profits, because now you have an unlimited access to growth when it comes to the profit margin. While this person, me who sold, have lost any future gains on that. Okay, and that's how it works.
B-E-T-A-B-E-T-A-I-N-C. Zeta, betas until we D-I-E. Cause I'm loving myself real good.
Did you guys hear that? I'm scared.
In a way that you'll never